Hey, you know, we just got reports that DuPont is going to stop contributing to its pension here in the next couple of years. But you know, this pension dilemma started way back in 2008, and even before that. IBM did away with its pension. Why? Because they had too few workers to continue to pay for the pension moving forward. We're seeing this with the interstate truckers, we're seeing with the merchant marines, and what they're finding out is the pension isn't longer viable. And what I mean by that is those pensions might only be lasting 8, 10, 12 years. And you know what? That's a big dilemma for somebody when they find this out. They might be 65, they might be 70. You know what? They can't go back to work, and if the pension goes away, working at Walmart or Home Depot isn't going to do it. So we have a specialist here. Her name is Michelle Cole. She's with Cole Reverse Mortgage, and she's going to talk to us about how people are replacing their pension to make sure they can live the life they want. Michelle, welcome to the show.
Thank you so much, Steve. It's always a pleasure to be here.
I'm glad you're here, and this is a big topic. You know, we're just seeing that tip of the iceberg, and you know what? I know you have a story about somebody you worked with named Bernie.
Yes. So, Bernie fits right into exactly what you were talking about. He worked for the Merchant Marine. He was worked on boats, ships, hauling freight all over the Pacific Rim for about 30 years. Then he retired. Thought, wow, I got this nice pension, going to last me forever. So 10 years down the road, he's 63, and he gets this letter saying his pension's going away in 12 years, just like what you were talking about.
That's nuts.
It's awful. I mean, can you imagine how you'd feel? So he goes, okay, what do I do? That means I got to go back to Home Depot or something, because his skill set is like, remember, working on chips. He's not into tech or any of those things, so he's saying, what do I do? So he goes to his financial advisor, and that's the important key. He goes in and goes, okay, what do I do? The financial advisor looks at what he's got and goes, Bernie, this is not going to last as long as you need it to. You're going to need some help. But the financial advisor's smart and said, you know, maybe you ought to consider a reverse mortgage as part of this piece. And it says a little bit about, you know, check to see about the line of credit, equity line. So talks to a reverse mortgage specialist, and what he finds out is the equity line with a reverse mortgage grows over time. The way it was figured is he would get about $312,000 to start with, and with the growth rate, that could take him in 12 years to about $580,000. And what that means is that $40,000 a year pension is going to be completely replaced in 12 years. When it runs out, then he's got that money. And plus, you know, Bernie's got other assets, his financial advisors telling him what to do, and with a growth rate of about 5%, Bernie's going to be able to extend the life of his assets, not only to 75, 90, but up to 100 now.
Well, you know what? So basically what you're saying is this. You know, this is a thing that's going to be happening with a lot of people.
Oh, yeah.
You're 65, you find out your pension's going to go away or get reduced.
Yeah.
And you're going, okay, if I'm losing $3,000 or $4,000 a month,
yes,
I can't go to work at Home Depot or Lowe's because they just can't pay me enough.
No.
I am a little bit older in the workforce, so it's tough to go get, you know, retrained.
Exactly.
So what am I going to do?
Yeah.
My options are to take my current assets and see if they work out, and if they don't, I've got to find something else. And you just said, hey, we can use a reverse mortgage, and it's because of the irrevocable equity line.
Correct.
That means nobody can take it away, but it's going to grow.
Not like the pension.
But it's going to grow with an interest rate.
Yeah.
And I could use that at some time in the future.
Yes. Yes.
Oh, that's a wonderful story.
It's huge. And what if Bernie needs health care and other things down the road? He's going to have that chunk of money that's sitting there growing. So when it gets to that point, he has access to money that's there for him, not going to go away. And if interest rates are maybe a little higher, maybe it's even a higher growth rate. So maybe it's more money. Maybe it's $600,000. Maybe it's a little bit over that even.
So basically what you're telling me what Bernie's doing is he's using the, you know, I was just doing quick math, it's about 15 years that $580,000 would last. But the other money, the financial advisor said, hey, let's grow this.
Exactly.
So we've got 12 plus 15 years is 27 years for this to grow to be in a position where you can use it after the age of 75.
Correct.
Wow. That's you know what, that's
Yeah.
some good planning, and you know what, I'm glad, you know what, I'm really glad you're here, because a lot of people don't understand this, and if they understood what it could do for them, it'd make a big difference in their life. And you know what, whether they're, you know, don't need it right now, it'd make a sense to take a look at a reverse mortgage, depending
Absolutely.
on. That's
You
great.
know, and the best thing, Steve, is there's no costs involved with that money sitting there. So it just sits there growing. You're not paying anything for that just sitting there. It's huge for people.
I got to ask this question, because you got to
Yeah.
dispel a myth when it comes to reverse mortgages.
Yes.
Everybody thinks, hey, what happens if Bernie passes away when he's 73 and doesn't use any of it? Does the house go to the bank?
No,
What happens?
of course not. Yes, that's the biggest myth going. Everybody asks me the same question, and I say, no, you're the only one on title. It does not go to the bank. And plus, if Bernie never used it, he's not going to be paying for it. It's not a loan against his property. It's available funds, but it's not a loan against it until he uses it. And even then, he'd probably have plenty of equity. So his heirs would get that equity when the home is sold or refinanced. So, no.
Well, you know what? If he
thing.
just used a little bit of it, how would the heirs get the home? Would they have to pay off that little loan that he had?
Yeah, it's a loan.
Okay.
A mortgage, it's a mortgage. So yeah, if there's a loan balance, it gets paid off. But more than likely, there's plenty of equity. It's just like any other home. If you've got a mortgage on it, when you sell it, you pay off that loan and you keep the difference in equity.
Okay, so money still goes to the heirs, which is important.
Absolutely, yes.
You know what, Michelle, thank you so much for dispelling that myth, but more importantly, giving that information today, because with all these pensions having issues, we're going to see it more and more. A reverse mortgage is going to make more and more sense to people down the road.
Yes, you're right.
Thank you so much.
Thank you, Steve. Pleasure.
Hey, for more information on reverse mortgages, to find out if it fits you, you want to go to the Silver-Haired Tsunami website. Hey, stick with us. We'll be right back.